This is the Retirement Solution Podcast with financial advisor John Hicks, founder of J. Hagan Capital.
Glad to have you here with us on the Retirement Solution. And if you have questions about your retirement savings plan, be sure to visit us at retirementsolutionradio.com. That's where you can go to get more information, to sign up for an in-office visit or a digital visit as well. We offer those. We also have links posted in the show notes, so you can just click there. Or again, visit us at retirementsolutionradio.com. Okay, let's talk about the thing that you love the most to hate. Is that am I properly saying?
Love the most to hate. No, that's okay.
Love hating the most. Is that a better way to talk about taxes?
Love hating the most. Oh, taxes. Yes.
When it comes to most things that most Americans love to hate, I think taxes are right there at the top of the list.
And it's been that way since the Boston Tea Party, right? I mean, there is a long-standing history of Americans not loving taxes. So,
and here we are, despite our efforts of our founding forefathers and mothers, through flinging that tea about, here we are.
Yeah.
With this tax talk. So what I think is interesting and educational for me in the conversations I've had with you and for so many people as they get into their retirement is how much the game changes for our tax planning with retirement. Actually, and really, it changes for the good. If you know what you're doing, there's lots of opportunities that people don't realize. So that's what I want to ask you about, because obviously with taxes, everybody's saying with the Trump tax cuts, taxes have been on sale since 2017. Is that when that law went into
2017 when it was passed. 2018 is when we kind of understood the rule well enough to start trying to exploit it accurately and correctly to try to do better, out of the ruling. Yeah.
So, and we have until December 31st, 2025
That's it.
to continue to take advantage of it. And so that has brought up the conversation about Roth conversions. And
absolutely,
should people be taking advantage of these lower tax rates while we have it and doing Roth conversions on their money that has not yet been taxed in their 401ks and in their IRAs? But we're not done yet, because that brings on more questions about best approach, best practices. So when it comes to RMDs, based on when you were born, your first required minimum distribution is due either when you turn 73 or when you turn 75.
Correct.
And that will continue annually through the rest of your life in your retirement years. Okay. So this is obviously because Uncle Sam, he wants his cut of that. What hasn't been taxed yet, Uncle Sam's like, give me mine. You got to start taking it out from your 401k, even if you don't need it.
Absolutely.
I want my money. So tax guru Ed Slott was saying one way to mitigate the taxes you pay is to convert some of an IRA to an after-tax Roth account, as we were discussing. But he was talking about on Morningstar that it's best to do this before you take your RMDs. Here's Mr. Slott.
So if you're in RMD territory, you have to take the RMD. You must take it, and you pay tax on it, and it cannot be converted. Once you satisfy that year's RMD, then any part or all of the remaining IRA balance can be converted. But it costs more because you had to pay the tax on the RMD, which couldn't be converted. Best time is usually like in your 60s. Do a series of maybe smaller annual conversions over time. In a perfect world, you get rid of your whole IRA before 73, then you have no RMDs and you have a tax-free Roth.
Now that he said it, we've talked about this before, this window, this magic period of time between 59 and a half to 72, 73 before RMDs kick in.
Absolutely.
This opportunity of time that we have to do Roth conversions. Let's talk about what you've done for clients in your office and before reaching RMD age, what we should be thinking about.
Sure. Yeah. When you kind of think about how we were all told in the beginning or trained in the beginning or what our CPAs or tax person said, they typically said, hey, you definitely want to save some money for retirement. And back in the day, most of us got company matches. So we would put money in our 401k. And why would we do that? Well, because we want to save money for retirement. But then on top of that, our company would often match us some money. They may give us an extra 3% or whatever they put in. They would put more money in for us, which made it a double attractive thing. And then the third piece of the puzzle was we get a tax break that year for putting the money in. If we put in, let's say, $10,000 into our 401k, we weren't taxed on that $10,000. Right. So when you think about all the stuff that we heard in the beginning, that was all very positive on why we should put that money away to save for a rainy day, to avoid taxes today, and then hopefully to get some money matched. Now, when you flash forward to where we are today, things have kind of changed a lot. Or for many of us, maybe we've changed a lot because we've aged.
Right.
And we have different things that we're looking to do. So one of the greatest things that happened more recently is the government said, hey, you do not have to take a required minimum distribution at 70 and a half anymore. And remember, if we remember, it used to be 70 and a half. The year after you turn 70 and a half, you had to take your first required minimum distribution.
Right.
The government's changed that. So now, depending on when we were born, our first required minimum distribution is either 73 or as late as 75. Now, what this does is it opens the door for a lot of us to do some tax planning that's a little different than we were trained in the past. So what we're looking at now, and it's not just because tax rates have been on sale, what we're looking at now is saying, okay, I put this money away. Let's say that we've saved $1 million in our 401k or IRA. So there's $1 million that's in our account. And we look at every one of those dollars as it belongs to us. And we haven't paid the government any taxes or very limited taxes on most of that money. Mm-hmm. The problem is the government is going to force us to pull that money out, whether we want to or not, at either age 73 or 75. And they're going to tax us at whatever they say the current tax rate is based on our income level. So the interesting thing when you do the math, it depends on how long we're going to live on this planet, right? But when you kind of think about it, there are a lot of ways that we could potentially save hundreds of thousands of dollars if we time it a little bit better and we pull the money out maybe earlier, pay the taxes ahead of the time we're supposed to, just so that we can save money in the long run. And that's exactly what Ed Slott was talking about. Right. So a lot of people have heard this guy's name. He's kind of the self-proclaimed IRA expert. He's a CPA by trade, but a lot of his math really kind of coincides with what we've been saying for a long time. Hey, you did a great job saving money. You got this big old pile of money, but that $1 million in that 401k doesn't all belong to you. The government's going to take a portion of it, and it's up to you. Do you want to take it out a little bit earlier and maybe pay only 12% current tax rates, or maybe 22 or 24% tax rates? It's a choice, and you don't have to do it yet. But if you did that, that might be a lot more attractive than paying 25 or 28 or 34% on those dollars that you have to pull out anyway in the future. And there's a lot of math surrounding that where we can show most people, if you've saved well and you live within your means, you can literally save tens of thousands of dollars, if not hundreds of thousands of dollars, by taking those dollars out in what we call asset shifting those assets from that tax deferred account into a tax-free account, whether it be a Roth or there are a handful of other tax-free assets that we can utilize, but the Roth is the most convenient, the one that most people use. But by putting that in the Roth, we can control not only when we pay taxes, but we might be able to control how much we pay, which is really important. There was a couple the other day, and we were just doing the math, and they saved about $1.6 million. Really great amount of money. They actually had some pensions, not tremendous amounts, but they were going to have about $30,000 a year coming in from pensions. And then their Social Security, got to look here, their Social Security was going to be about another $39,000 a year. And they were saying, John, I think they were getting close to being 70. They were still in their late 60s. And they were asking, it's like, John, we'd like to probably live off another $40,000 or $50,000 a year to travel, to entertain, to do some things around the house. We kind of wanted to do a new wraparound front porch. The gentleman was thinking about maybe putting up a new pole barn in the back so we could have a spot to maybe work on some classic cars in his spare time, because they just retired and they were looking at what they wanted to do. And we were looking through the math, and I was like, guys, this is a really perfect case scenario to show you if we maneuvered some money over the next 5 or 6 years, we might be able to save about $380,000 in future taxes, either that you would pay or your heirs would pay, by doing these things. And they were in disbelief. It's like, whoa, what are you talking about? We did the math. Because of what they were going to have to pull out at the age of 73 because of required minimum distributions, it was going to put them in a higher tax bracket for the remainder of their lives, whether they lasted into their very late 70s or whether they lasted into their late 90s. They were going to be in a better situation if they converted some of that money at lower tax brackets now. And we went through it substantially time over time. And what they said was, well, our current advisor didn't talk about this. I'm like, well, he believed in the old school math, right? Yeah. Put it all away, defer as much taxes as you can. And when you have to do it, you'll have to do it and you'll pay the piper then. But by simply saying that there are better ways to be more proactive with when we pay those taxes, and they looked at almost a $308,000 tax savings if they both lasted normal life expectancy, so 83 to 86, male and female. We're talking over $300,000 in savings that their heirs or they would potentially have the chance to use. Because one of their other fears was, do we have enough money to pay for healthcare? Well, if we can save potentially a couple hundred or $300,000 in tax savings, guess what that money becomes available for? For potential use of healthcare if we had that situation. And so by doing very limited planning, very limited movements, they were able to feel much more comfortable, and we looked at doing that plan going forward. But it's those types of things that we just kind of want a second opinion on, just to find out, hey, does the math work for you? Because there's a lot of people, the math does not suggest that they should actually do the conversions. And I say this all the time.
Which is a great point, because there are a lot of people out there that are talking Roth, and everybody thinks Roth's going to save the day. And it's like, whoa. Pump
They're
the
in
brakes.
a situation where it makes little sense at all for them to do that. Either because they're overspending compared to what they've saved, they have tremendous income from other asset sources, or frankly, they're just in a higher tax bracket than their heirs would be in the end. And in those situations, it doesn't always make a lot of sense unless we thought that the government was going to raise tax rates through the roof. No, none of our plans even suggest that that could be the case. But if we're paying a lower tax rate now, if the government did increase tax rates tremendously, you'd just be in that much of a better situation if the math works out for you now.
Bottom line, doing the math to find out how much more of your money you can keep in your pocket and out of Uncle Sam's hands. That is the point of running these numbers on your savings and investments to help you understand what opportunities you might have. In the case of this one couple, saved over $300,000 just by making some moves in their plan, not by having to save a lot more money or do anything crazy, just shifting some things. And this is what John and his team at J. Hagan Capital can do with and for you. Run the numbers, see what could work within your savings and investments. So visit us at retirementsolutionradio.com. That's where you can get to work starting this conversation with John and his team. We also have links posted in the show notes, or again, find us anytime, retirementsolutionradio.com.
Thanks for listening to the Retirement Solution Podcast with John Hicks. Begin the conversation about your savings plan with John and the team at J. Hagan Capital by visiting retirementsolutionradio.com. Be sure to listen to John's radio show, The Retirement Solution, Saturdays at 8 a.m. and Sundays at 9 a.m. on News Radio 840 WHAS.
J. Hagan Capital Inc. is not licensed in all 50 states. To find out if J. Hagan Capital Inc. is licensed in your state, please call 502-690-5635. J. Hagan Capital Inc. is not affiliated with nor endorsed by the Social Security Administration or any other government agency. It does not provide legal or tax advice. Annuity guarantees rely solely on the financial strength and claims paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through J. Hagan Capital. National license number 188279094.